An investor group led by Warburg Pincus just agreed to buy ECN Capital for $3.10 a share, a 13% premium to the stock's last close, valuing the company at roughly $1.9 billion. But why this happened is even more surprising, and the real consequence comes later. Back up a moment. ECN wasn't always a tidy package. It began as a spin-off almost a decade ago from what's now Element Fleet Management. And over the years, CEO Steve Hudson quietly rebuilt it into a specialty financier focused on manufactured housing, recreational vehicles, and marine lending. Along the way, ECN sold two big pieces of the business, one to Truist Bank in 2021 and another to Stone Point in 2022. And those sales changed everything. Trading volume on ECN's stock fell markedly, and what remained were two lean operating segments managing about $7.6 billion in assets. So here's the twist. Hudson, who at 67 still owns about 7% of the company, decided the time was right to sell what was left. He argues these financing businesses have reached a size where they're better off under the wing of a giant bank, an insurance firm, or a massive private equity fund with deeper pockets. He's speaking from experience. In the 1990s, his Newcourt Credit Group stumbled when long-term loans were funded with short-term commercial paper. A classic liquidity mismatch. This time, he avoided that mistake. ECN bought its service finance arm for $309 million in 2017 and sold it to Truist for about $2 billion, a multiple that Hudson calls a great outcome. Since the 2016 spin-off, shareholders have seen more than 200% returns. But here's where things get complicated. The deal is all cash. It carries only minimal closing conditions, and it's expected to wrap up in the first half of 2026, subject to court approval and the usual regulatory checks. For shareholders, that's a straightforward liquidity event and another return of capital. For Warburg Pincus, it's a bet. Buy a pair of steady niche finance businesses and scale them with better access to capital markets, deposits, or securitization tools that banks and big funds can leverage. Who wins and who loses? Winners include ECN shareholders who get immediate cash at a tidy premium, and Hudson himself, who monetizes part of a long track record of deals. Warburg gains predictable cash flows in sectors that, while boring to many investors, are very lucrative to specialists. Potential losers are the public market itself, as more small, specialized finance firms get scooped up by private buyers. Retail investors lose opportunities to participate in future upside. Employees and customers may benefit from more stable funding, but they could also face integration changes under private ownership. What should you, the viewer, take away? If you own shares in small finance companies, expect private equity interest to keep rising, and that can mean faster buyout bids and less liquidity. If you're a borrower in manufactured housing or RV financing, this could mean more capacity and possibly different terms as a bigger owner reshapes underwriting. And if you're watching the market for bargains, remember, consolidation is a powerful force. Niche lenders with consistent cash flows are prime targets when trading volumes fall, and public valuations don't reflect strategic value. So is this the final curtain for ECN or the opening move in a larger roll-up by private capital? That's the question to watch as this deal moves toward 2026. Because what happens to these quiet cornerstones of consumer finance often foreshadows bigger shifts in how credit is funded and who controls it.